Good day, dear traders all around the world. Today we have interesting topic about open-end ETF and a closed-end ETF. If we start speaking about open-end ETF, in this video we will cover the difference between them regarding liquidity, market pricing, passive and active management, and we will start now by saying some interesting facts that should everybody know. The first open-end ETF spread S&P 500 ETF, which is short by SPY, launched in 1993, was the largest and the most traded ETF, and it was the first open-end ETF. The first closed-end fund was the Boston Personal Property Trust, launched in 1893, is considered one of the first closed-end funds. If we speak about premium and discount, unlike open-end ETFs, closed-end funds can trade at 50% premiums or discounts to NAV, creating arbitrage opportunities. If we speak about leverage use, many closed-end funds use leverage to enhance returns, making them riskier. So let's start our presentation. What is an ETF in general? ETF is an exchange traded fund, is an investment fund that traded on stock exchange. Much like stocks, ETFs typically hold assets such as stocks, commodities, or bonds and generally operate with an arbitrage mechanism designed to keep trading closely to its net assets value. Net assets value, if we make a term for it, we will say NAV. Key difference between the open-end and the closed-end ETF. There are many important key factors. Key difference: structure, trading, liquidity, and price mechanism. If we speak about structure, open-end ETF can create and redeem shares while the closed-end ETF have a fixed number of shares. If we speak about trading, open-end ETF it trades to NAV, while a closed-end ETF may trade at a premium or discount. Liquidity. If we are speaking about open-end ETF, have higher liquidity due to continuous share creation or limitation. Price mechanism, open-end ETF attract to their NAV closely, whereas the closed-end ETF may deviate. Open-end ETF shares can be created or redeemed at NAV. Liquidity is ensured by authorized participants. Price closely track NAV due to arbitrage suitable for investors seeking low cost and investment. So here was some information about open-end. If we speak about the brief history of ETF, 1960s to 70s was concept of index fund emerges. In 1989, the first ETF like Toronto 35 Index Participation Unit launched in Canada. 1993, the first US ETF SPY is launched. 20s explosion of ETF with sector bonds and international offering. 2010 and 2020 up to 2020 was active ETFs. thematic ETFs and the crypto ETFs like Bitcoin ETFs gain popularity. So we continue our presentation. Now we speak about a closed ETF, which is much more older than open ETF. It is fixed number of shares issued at anticipation. Prices can be traded at a premium or discount to NAV. Market demand dictates shares prices, higher volatility compared to open-end ETF. If we speak about what is positive, what is negative about open-end ETF, we see lower cost, high liquidity, NAV tracking, and subject to market volatility. This is not something you have. This is something you have to consider when you make a decision about investing in ETF. If we speak now about a closed-end ETF, potential for premium trading, active management, price volatility, limited liquidity. In the end, both open-end and closed-end ETF offer a unique benefits. Investors should consider their investment called risk and liquidity needs before choosing between them. In the end of this video, I would like to say thank you for everyone watching this video. I will appreciate any question regarding this topic and wait for more videos